Most people don't fail at investing because they're lazy or unintelligent. They fail because they're overconfident, overcomplicated, and constantly distracted by noise. Think about it. Every day, headlines scream, "Buy this stock, sell before it crashes." This one trick can beat the market, and yet after decades of trying, most investors still underperform the market. So here's the real question. What if the secret to winning at investing isn't doing more but doing less? That's exactly where the Bogleheads Guide to Investing begins. This book isn't written by Wall Street traders or hedge fund wizards. It's written by everyday investors who follow one radical idea inspired by John C. Bogle, the founder of Vanguard. You don't need to be smarter than the market. You just need to stop fighting it. No stock-picking genius, no market timing, no complicated strategies. Instead, this book teaches you how to win quietly by keeping costs low, staying diversified, ignoring hype, and sticking to a simple plan for decades. And here's the uncomfortable truth most people don't want to hear. The biggest enemy to your wealth is not inflation, recessions, or bad luck. It's you, your emotions, your impatience, and your need to do something when markets get scary. The Bogleheads Guide to Investing shows you how to build a portfolio that works, even when you're asleep, even when markets crash, even when everyone else panics. In this video, we'll break down the core ideas of the Bogleheads philosophy: why simplicity beats complexity, why costs matter more than returns, and why staying the course can make ordinary people quietly wealthy. If you've ever felt overwhelmed, confused, or burned by investing, this book and this summary might completely change how you think about money. Let's begin. Chapter 1 of the Bogleheads Guide to Investing doesn't start with stocks, bonds, or returns. It starts with something far more important: how you live your life. The authors make one thing clear from the beginning. Investing success is not about chasing high returns. It's about building a financial lifestyle that allows investing to work over time. The core idea is simple. You can't out-invest bad financial habits. If you spend everything you earn, borrow excessively, or inflate your lifestyle every time your income increases, no investment strategy will save you. Wealth is built from the gap between what you earn and what you spend. The Bogleheads emphasize living below your means, not to feel deprived, but to gain control. This means avoiding lifestyle inflation, being intentional with spending, and understanding the difference between what you truly need and what society pressures you to want. Another major theme in this chapter is delayed gratification. The authors argue that long-term financial success comes from choosing future freedom over short-term pleasure. Saving and investing early, even in small amounts, creates habits that compound just like money does. They also stress the importance of eliminating high-interest debt. Credit card debt, car loans, and unnecessary consumer debt act like negative investments, often earning worse returns than any market crash ever could. Before worrying about asset allocation, you must stop financial leaks. Importantly, Chapter 1 reframes wealth. Wealth is not flashy purchases or visible success. Wealth is financial independence, flexibility, and peace of mind. It's the ability to make choices without money constantly controlling your decisions. The chapter closes with a mindset shift. Investing is not a way to get rich quickly. It's a lifelong process built on discipline, patience, and consistency. Your financial lifestyle sets the foundation. Everything else in the book builds on it. In short, before you touch the market, the Bogleheads want you to fix your behavior. Because the most powerful investment decision you'll ever make isn't picking a fund. It's choosing how you live. Chapter 2 focuses on one of the most powerful forces in investing: time. The Bogleheads make a direct point. You do not need extraordinary returns to build wealth. What you need is an early start in consistent investing. Time, not talent, is the real advantage. This chapter introduces the concept of compound growth, not as a theory, but as a practical reality. Money that is invested early has more time to grow, and the returns themselves begin to earn returns. Over decades, this compounding effect becomes the main driver of wealth, far outweighing short-term market movements. The authors show that delaying investing by even a few years can dramatically reduce long-term results, even if you invest larger amounts later. Someone who starts early with smaller contributions often ends up with more money than someone who starts late but invests aggressively. Another key lesson is regular investing. The Bogleheads strongly support dollar-cost averaging, investing a fixed amount on a consistent schedule. This approach removes emotion from the process. You invest when markets are up, when they are down, and when headlines are scary, over time. This discipline smooths out market volatility. The chapter also emphasizes automation. By automatically investing from each paycheck, you turn investing into a habit rather than a decision. This reduces the temptation to time the market or wait for the perfect moment, which rarely arrives. Importantly, the authors challenge the idea that you need a lot of money to start. They argue that starting small is infinitely better than not starting at all. Early contributions build not only capital, but confidence and discipline. The chapter reinforces a critical mindset. Investing success is not about predicting markets. It's about participation. You win by staying invested long enough for compounding to do the heavy lifting. In short, Chapter 2 delivers a simple but powerful message. Start now, invest regularly, stay patient. Because in investing, time is the one advantage you can never buy back once it's gone. Chapter 3 introduces a core Bogleheads principle. Never invest in something you don't understand. The authors argue that many investors buy products based on performance charts, tips, or sales pitches without knowing what the investment actually is, how it works, or what risks it carries. This lack of understanding is one of the main reasons investors panic, make bad decisions, and sell at the wrong time. This chapter begins by clearly defining the two basic asset classes, stocks and bonds. Stocks represent ownership in businesses. When you buy a stock, you own a small piece of a company and participate in its profits and losses. Stocks offer higher long-term return potential, but they also come with higher volatility and risk in the short term. Bonds, on the other hand, are loans. When you buy a bond, you are lending money to a government or corporation in exchange for interest payments and the return of your principal. Bonds are generally more stable than stocks, but they offer lower expected returns. The key message here is balance. Stocks provide growth, bonds provide stability. Understanding the role each plays helps investors build portfolios they can stick with during market downturns. The chapter also introduces mutual funds and index funds. Instead of buying individual stocks or bonds, investors can buy funds that hold many securities at once. This provides instant diversification and reduces the risk of relying on a single company or issuer. The authors strongly favor index funds, which simply track a market index rather than trying to beat it. They explain that most actively managed funds fail to outperform the market after costs, and investors often don't realize how much fees reduce long-term returns. Another important theme is risk awareness. Every investment involves trade-offs between risk and reward. If you don't understand where returns come from or why prices move, you're more likely to react emotionally when markets decline. Chapter 3 sets the foundation for smarter investing decisions. Before choosing any fund or strategy, the Bogleheads insist on one rule: understand the investment, understand its role in your portfolio, and understand the risks you're accepting. Because confidence in investing doesn't come from predictions, it comes from clarity. Chapter 4 continues the theme of understanding your investments, but now shifts from basic asset classes to how investments are structured and packaged. The authors focus on one critical warning. Many investors don't lose money because markets fail. They lose money because they buy complex products they don't fully understand. This chapter breaks down common investment vehicles and highlights where confusion and hidden risks often appear. First, the Bogleheads expand on mutual funds, explaining the difference between actively managed funds and index funds in more detail. Actively managed funds rely on managers trying to outperform the market by selecting securities or timing trades. The authors point out that this approach introduces higher costs, higher turnover, and higher taxes, all of which reduce investor returns over time. Index funds, by contrast, follow a rules-based approach. They track a market index, trade less frequently, and operate at much lower cost. The key takeaway is not that index funds are exciting, but that they are predictable and efficient. Which matters more in the long run? The chapter also discusses exchange-traded funds ETFs, explaining that while ETFs can be useful, they are often marketed as trading tools rather than long-term investments. Frequent trading, even with low commissions, increases the risk of emotional decision-making. Next, the authors caution against performance-based thinking. Many investors choose funds based on recent returns, without understanding why those returns occurred or whether they are repeatable. The Bogleheads emphasize that past performance is not a reliable indicator of future results, especially after costs. Another important section addresses complex and exotic investments, products that promise downside protection, enhanced returns, or market-beating strategies often involve leverage, derivatives, or opaque structures. The authors argue that if an investment cannot be clearly explained, it should not be owned. The chapter reinforces a simple rule: complexity usually benefits the seller, not the investor. Chapter 4 closes by urging investors to favor simplicity, transparency, and low cost. The more understandable an investment is, the easier it becomes to stay disciplined during market stress. The message is consistent with the Bogleheads philosophy. Know exactly what you own, why you own it, and how it behaves, because clarity is what keeps you invested when markets test your patience. Chapter 5 addresses a risk many investors underestimate: inflation. The Bogleheads explain that inflation is a silent enemy. It doesn't feel dramatic like a market crash, but over time, it steadily erodes the real value of your money. Even low inflation, compounded over decades, can significantly reduce purchasing power. This chapter focuses on one specific tool designed to fight this risk: inflation-protected bonds, especially Treasury inflation-protected securities, or TIPS. The authors explain how traditional bonds work first. Standard bonds pay fixed interest and return a fixed principal. The problem is that if inflation rises, the real value of those fixed payments declines. Investors may feel safe because prices don't fluctuate much, but their purchasing power quietly shrinks. TIPS work differently. The principal value of TIPS adjusts with inflation. When inflation rises, the bond's principal increases and interest payments rise with it. When inflation falls, the principal can decline, but at maturity, investors receive at least the original principal. The structure provides direct inflation protection, something traditional bonds cannot guarantee. The Bogleheads are careful to set expectations. Inflation-protected bonds are not designed to generate high returns. Their primary role is risk control, not growth. They exist to preserve purchasing power and stabilize a portfolio, especially for investors who rely on their investments for future spending. The chapter also discusses where inflation-protected bonds fit best. They are most useful for long-term goals like retirement, where inflation risk is highest. They can be particularly valuable as part of the bond allocation for conservative investors or retirees. Another important point is diversification within bonds. Just as stocks are diversified, bond holdings should also be diversified across different types of risks, including inflation risk. TIPS are one way to accomplish this. Chapter 5 reinforces a broader Bogleheads lesson. Investing is not only about maximizing returns, it's about managing risks you can't afford to ignore. Inflation-protected bonds may not be exciting, but they serve a clear purpose. They help ensure that the money you save today can still buy what you need tomorrow. Chapter 6 tackles one of the most practical questions every investor asks: how much is enough? The Bogleheads make it clear from the start. There is no universal number. The amount you need to save depends on your lifestyle, your goals, and how long your money needs to last. Instead of guessing, the authors encourage a planning-based approach. The chapter begins by shifting focus away from chasing returns and toward controlling savings rate. Returns are uncertain and unpredictable, but how much you save is largely within your control. A higher savings rate reduces dependence on market performance and increases the probability of reaching financial independence. The authors introduce basic retirement planning concepts, emphasizing the relationship between current spending and future needs. If you want to maintain your lifestyle in retirement, you must first understand how much you actually spend today. Retirement planning starts with expenses, not income. Another key idea in this chapter is replacement ratio. the percentage of your pre-retirement income you'll need after you stop working. The Bogleheads explain that many people need less income in retirement than they expect, due to lower taxes, reduced work-related costs, and possibly a paid-off mortgage. However, healthcare and longevity risks must also be considered. The chapter highlights the danger of underestimating life expectancy. With people living longer, retirement can last 20 to 30 years or more. Saving too little creates the risk of outliving your assets, which is far more damaging than saving too much. The authors also discuss the role of retirement accounts and the importance of taking full advantage of tax-advantaged plans. Contributions to employer-sponsored plans and IRA letters not only grow over time, but also benefit from tax efficiency, making saving more effective. Importantly, Chapter 6 avoids false precision. The Bogleheads stress that planning is an ongoing process, not a what-I'm calculation. Assumptions will change, markets will fluctuate, and life will evolve. The goal is to regularly review progress and adjust savings as needed. The central message of this chapter is discipline over perfection. You don't need an exact number to start. You need a commitment to save consistently. Increase savings over time and align your spending with your long-term goals. Because in investing, saving enough matters more than investing brilliantly. Chapter 7 delivers one of the most important principles in the entire book. Simplicity is a competitive advantage. The Bogleheads argue that many investors believe complexity equals sophistication. In reality, complexity often leads to confusion, higher costs, more mistakes, and worse results. The more moving parts a portfolio has, the harder it becomes to understand, manage, and stick with during market stress. This chapter emphasizes that successful investing does not require constant action. It requires a simple, well-structured plan that can be followed consistently over decades. The authors explain that complicated portfolios with many overlapping funds rarely provide meaningful diversification. Instead, they often create redundancy, hidden risks, and unnecessary rebalancing challenges. Investors may think they are spreading risk, but in practice they are just making their portfolio harder to manage. A key message in this chapter is behavioral discipline. Simple portfolios are easier to maintain because they reduce decision-making. Fewer funds mean fewer chances to second-guess, chase performance, or react emotionally to short-term market movements. The Bogleheads also connect simplicity directly to cost control. Every additional fund, strategy, or transaction tends to increase expenses, taxes, or trading activity. Over time, these small frictions compound negatively, reducing long-term returns. The chapter reinforces the idea that more choice does not lead to better outcomes. In fact, too many options often paralyze investors or push them toward frequent changes. A simple portfolio encourages patience and long-term thinking. Another important point is that simplicity supports clarity of purpose. When each investment has a clear role, growth, stability, income, investors are more likely to stay committed when markets decline. Confusion leads to panic, clarity leads to discipline. Chapter 7 does not argue for minimal effort. It argues for intentional design. The goal is not to own fewer investments for convenience, but to own only what you need to meet your goals effectively. The takeaway is straightforward. A simple strategy, executed consistently, beats a complex strategy that you can't maintain. In investing, simplicity isn't a shortcut, it's a long-term advantage. Chapter 8 explains what the Bogleheads consider the most important investment decision you will ever make: asset allocation. Asset allocation is how you divide your portfolio among major asset classes, primarily stocks and bonds. According to the authors, this single decision determines the majority of your portfolio's risk and long-term behavior, far more than individual fund selection or market timing. The chapter begins by clarifying that asset allocation is not about maximizing returns. It is about finding the right balance between risk and your ability to stay invested. A portfolio that looks good on paper but causes panic during market downturns is a bad allocation. Stocks provide growth but come with volatility. Bonds provide stability and income but lower long-term returns. The right mix depends on several personal factors: time horizon, financial goals, income stability, and emotional tolerance for market swings. The Bogleheads emphasize risk capacity versus risk tolerance. Risk capacity is your financial ability to withstand losses based on age, job security, and time until you need the money. Risk tolerance is emotional, how you react when markets fall. A successful asset allocation must respect both. The chapter discourages rule-of-thumb formulas that ignore individual circumstances. While age-based guidelines can be useful starting points, they are not substitutes for thoughtful planning. Investors should adjust allocation as life changes, not based on market forecasts. Another key point is that asset allocation should be set in advance before markets become volatile. Making allocation decisions during market stress leads to emotional errors. The correct time to decide your risk level is when markets are calm. The authors also stress that asset allocation should remain relatively stable over time. Constantly adjusting allocations based on market conditions is a form of market timing, which the Bogleheads strongly oppose. Chapter 8 reinforces a core philosophy. Investing success comes from discipline, not prediction. A well-chosen asset allocation helps investors stay the course through bull markets, bear markets, and everything in between. The takeaway is clear. You don't need the perfect allocation. You need an allocation you can live with, one that allows you to remain invested long enough for your plan to work. Chapter 9 delivers one of the most uncompromising messages in the Bogleheads Guide to Investing. Costs are one of the few things investors can control, and they matter enormously. The authors explain that every dollar paid in fees is a dollar that can no longer compound for you. While market returns are uncertain, investment costs are guaranteed. Over long periods, even small differences in fees can lead to massive differences in outcomes. This chapter breaks down the main types of investment costs investors often overlook. These include expense ratios, transaction costs, sales loads, advisory fees, and hidden trading costs inside actively managed funds. Individually, these costs may seem minor. Collectively, they can consume a large portion of long-term returns. The Bogleheads emphasize that high costs create a performance hurdle. Before an actively managed fund can beat a low-cost index fund, it must first overcome its higher fees. The data consistently shows that most funds fail to do this over time. Another key idea is that costs compound negatively, just as returns compound in your favor. Fees compound against you year after year. A portfolio with higher costs doesn't just start lower, it falls further behind every decade. The chapter also challenges the belief that higher fees buy better results. The authors point out that there is little evidence that expensive funds or advisors consistently deliver superior performance. In many cases, higher fees simply reflect marketing, turnover, and complexity, not skill. The Bogleheads strongly advocate for low-cost index funds as a solution. These funds minimize expenses, trade infrequently, and pass more of the market's return directly to investors. The goal is not to outperform the market, but to capture as much of the market return as possible. Importantly, Chapter 9 frames cost control as a form of risk management. Lower costs reduce the pressure to chase returns or take unnecessary risks to make up for fees. The chapter closes with a simple but powerful conclusion. In investing, you don't need to be smarter than other investors. You just need to pay less. Because over time, the investor who keeps more of what they earn almost always wins. Chapter 10 introduces a critical reality of investing that many people ignore. What you earn before taxes is not what you keep. The Bogleheads emphasize that taxes can significantly reduce long-term returns, especially for investors who trade frequently or invest without considering tax efficiency. Just like costs and fees, taxes quietly compound against you over time. This chapter begins by explaining the basic idea of after-tax returns. Two portfolios with the same pre-tax performance can produce very different results, depending on how much tax they generate. Smart investors focus not only on returns, but on how much of those returns they get to keep. The authors break down common sources of taxable income in investing. These include interest income from bonds, dividends from stocks and funds, and capital gains from selling investments. Each type is taxed differently, And understanding these differences helps investors make better decisions. A major theme in this chapter is tax-efficient investing. The Bogleheads explain that frequent buying and selling creates taxable events. Actively managed funds, with high turnover, often generate capital gains distributions even when investors haven't sold anything themselves. This can lead to unexpected tax bills. In contrast, index funds tend to be more tax efficient. Because they trade less and follow clear rules, they generally generate fewer taxable events. This allows more of the return to compound over time. The chapter also introduces the idea of tax location. Different investments belong in different types of accounts. Tax-inefficient assets, such as taxable bonds, are often better held in tax-advantaged accounts. More tax-efficient assets, like broad stock index funds, can be suitable for taxable accounts. The goal is to reduce unnecessary tax drag. Another important message is long-term thinking. Deferring taxes, even if you don't eliminate them, allows money to grow longer. The longer taxes are postponed, the more powerful compounding becomes. Chapter 10 reinforces a core Bogleheads principle. Taxes are not something you react to later. They are something you plan for in advance. The takeaway is straightforward. You don't need aggressive strategies to improve after-tax returns. You need awareness, patience, and a structure that minimizes unnecessary tax exposure. In investing, it's not just what you earn that matters, it's what you keep. Chapter 11 builds on the tax foundation from the previous chapter and moves from concepts to practical tax strategy. The focus here is not avoiding taxes illegally, but reducing unnecessary tax drag through smart planning. The Bogleheads begin by emphasizing the value of tax-advantaged accounts. Retirement accounts such as for 401(k)s IRAs and Roth accounts allow investments to grow either tax-deferred or tax-free. The authors strongly encourage investors to fully understand and maximize these accounts before investing heavily in taxable accounts. A key distinction in this chapter is between tax-deferred and tax-free growth. Tax-deferred accounts postpone taxes until withdrawals begin, allowing compounding to work on a larger base for many years. Roth-style accounts, while funded with after-tax dollars, allow qualified withdrawals to be completely tax-free. The choice between them depends on current versus future tax expectations. The chapter also discusses withdrawal planning, especially for retirement. Taxes don't end when you stop working, they simply change form. Required minimum distributions, or RMDs, can force taxable withdrawals later in life. Without planning, investors may face higher tax bills than expected. Another major topic is capital gains management. The Bogleheads explain the benefit of long-term capital gains, which are taxed at lower rates than short-term gains. Holding investments longer not only aligns with the Bogleheads philosophy, but also improves after-tax outcomes. The authors also introduce tax loss harvesting as a disciplined strategy. By realizing losses during market declines, investors can offset gains or income, improving tax efficiency without changing their long-term asset allocation. However, the chapter stresses following IRS rules carefully and avoiding emotional trading. Charitable giving is briefly addressed as another tax-aware strategy. Donating appreciated assets instead of cash can reduce capital gains taxes, while supporting causes investors care about. Throughout the chapter, the authors reinforce a consistent theme. Tax planning rewards patience and structure. Frequent trading, reactive decisions, and short-term thinking almost always increase tax costs. Chapter 11 concludes by reminding readers that tax efficiency is a lifelong process. Laws change, income changes, and portfolios evolve. The goal is not perfection, but ongoing awareness. The takeaway is simple. Smart investors don't ignore taxes. They design their investing strategy so taxes quietly take less over time. Because what compounds best is not just returns, but returns left untouched by unnecessary taxes. Chapter 12 focuses on a principle the Bogleheads consider non-negotiable. Diversification is essential to managing risk. The authors make a direct point. Diversification does not increase expected returns, but it reduces the risk of catastrophic outcomes. Its purpose is protection, not excitement. The chapter begins by explaining why concentrated investing is dangerous. Owning a small number of stocks, sectors, or countries exposes investors to risks that cannot be predicted or controlled. Individual companies fail, industries decline, and even entire markets can underperform for long periods. Diversification spreads risk across many securities so that no single failure can permanently damage the portfolio. The Bogleheads break diversification into several dimensions. The first is asset class diversification, mainly between stocks and bonds. Stocks drive growth, while bonds provide stability. Holding both reduces volatility and makes portfolios more resilient during market downturns. Next is diversification within asset classes. For stocks, this means owning companies across different industries, sizes, and geographic regions. For bonds, it means spreading exposure across many issuers and maturities. Broad market index funds naturally provide this type of diversification at low cost. A key warning in this chapter is against false diversification. Owning multiple funds does not automatically mean you are diversified. Many investors hold several funds that all invest in similar assets, creating overlap without real risk reduction. True diversification comes from owning assets that behave differently under different economic conditions. The chapter also addresses international diversification. The Bogleheads argue that limiting investments to one country increases risk. Global markets move differently over time, and international exposure can reduce reliance on the economic performance of any single nation. Importantly, the authors caution that diversification does not eliminate losses. During severe market declines, diversified portfolios can still lose value. However, diversification improves the chances of recovery and reduces the likelihood of permanent loss. Chapter 12 reinforces a broader message. Diversification works best when combined with long-term discipline. Chasing recent winners or abandoning underperforming assets defeats the purpose of diversification. The takeaway is clear. Diversification is not about predicting what will win next. It's about preparing for what you can't predict. In investing, the goal is not to avoid risk entirely. It's to survive it long enough for compounding to do its job. Chapter 13 delivers one of the strongest warnings in the Bogleheads Guide to Investing. Trying to outsmart the market often leads to self-inflicted losses. The authors explain that performance chasing, moving money into investments that have recently performed well, is one of the most common and damaging investor behaviors. Investors see strong recent returns, assume they will continue, and buy at elevated prices. When performance inevitably cools, disappointment sets in, and investors sell, often at the worst possible time. Market timing is closely related. It is the belief that you can consistently predict when to get in and out of markets. The Bogleheads argue that even professional investors struggle to do this successfully. Markets move quickly, unpredictably, and often in response to information that becomes priced in almost instantly. The chapter highlights a critical fact: missing just a few of the market's best days can drastically reduce long-term returns. Investors who jump in and out of the market risk being on the sidelines during recoveries, which often happen suddenly and without warning. Another key point is that emotional decision-making drives poor timing. Fear pushes investors out after declines, and greed pulls them back in after rallies. This behavior creates a pattern of buying high and selling low, the opposite of successful investing. The Bogleheads emphasize that headlines, forecasts, and expert opinions do not provide a reliable edge. Financial media thrives on predictions, but these predictions rarely improve investor outcomes. Acting on them increases turnover, taxes, and costs, all of which reduce returns. The chapter reinforces the importance of a predefined investment plan. Asset allocation and investment choices should be made calmly, in advance, not in reaction to market movements. Once a plan is in place, the best course of action is usually to do nothing. Chapter 13 also reframes inactivity as discipline. Staying invested during market volatility feels uncomfortable, but it is often the most productive decision an investor can make. The takeaway is straightforward. You don't need to predict the future to succeed. You need to avoid behaviors that sabotage long-term compounding. Performance chasing and market timing are tempting, but they are hazardous to wealth. The Bogleheads' solution is simple: stay the course. Chapter 14 shifts attention from retirement to another major long-term goal: paying for education. The Bogleheads begin by emphasizing that college investing should be treated differently from retirement investing. The time horizon is shorter, the goal is more specific, and the risk tolerance must be lower as the enrollment date approaches. Unlike retirement, there is no flexibility to wait out market downturns once tuition bills are due. A central theme of this chapter is goal-based investing. Money saved for college should not be mixed with retirement assets. Each goal requires its own timeline, asset allocation, and risk management strategy. The authors focus heavily on 529 college savings plans, explaining why they are often the most efficient option. Contributions grow tax-deferred, and qualified withdrawals for education expenses are tax-free. This tax advantage makes 529 plans especially powerful for long-term education savings. However, the Bogleheads stress that investment choices inside of 529 plans still matter. High fees, complex options, and aggressive allocations can undermine results. They encourage investors to favor low-cost options and age-based portfolios that gradually reduce risk as college approaches. The chapter also discusses asset allocation adjustments over time. When a child is young, college savings can be invested more aggressively. As the start date nears, portfolios should shift towards safer assets to protect against market volatility. This gradual risk reduction is critical to avoiding short-term losses at the worst possible time. Another important point is realism. The authors caution families not to sacrifice retirement security to fund college. Loans can be used for education, but not for retirement. Maintaining a balanced financial plan remains essential. The chapter briefly addresses financial aid considerations. While savings may affect eligibility, the authors argue that this should not discourage disciplined saving. Planning for education is still better than relying on uncertain aid outcomes. Chapter 14 reinforces a broader Bogleheads message. Investing is about matching strategy to purpose. College savings is not about maximizing returns. It's about ensuring funds are available when needed. The takeaway is clear. Successful college investing requires planning, discipline, and a clear timeline, not speculation. By keeping costs low, managing risk carefully, and separating goals, families can approach education funding with confidence rather than stress. Chapter 15 addresses a situation many people dream about, but often mishandle: receiving a financial windfall. A windfall can come from an inheritance, bonus, lawsuit settlement, sale of a business, or lottery winnings. The Bogleheads make a critical point early. Sudden money does not automatically lead to long-term wealth. In fact, without a plan, it often leads to regret. The chapter begins with a strong recommendation: don't rush. Emotional decisions made immediately after receiving a windfall often result in overspending, poor investments, or irreversible mistakes. The authors advise investors to pause, let emotions settle, and avoid major financial moves until a clear plan is formed. Another key idea is treating windfall money no differently than earned money. Psychologically, people tend to take more risk with found money, but the market does not distinguish between dollars earned and dollars received unexpectedly. Every dollar should be invested with the same discipline and purpose. The Bogleheads stress the importance of protecting the windfall first. This includes paying off high-interest debt, establishing or strengthening an emergency fund, and ensuring appropriate insurance coverage. Preserving capital takes priority over chasing returns. Next, the chapter focuses on goal alignment. Windfall money should support long-term goals such as retirement security, education funding, or financial independence, not short-term lifestyle inflation. The authors warn that large purchases made without long-term consideration often create ongoing costs that outlast the initial excitement. Asset allocation plays a central role here. Instead of investing the windfall all at once based on market conditions, the Bogleheads suggest integrating it gradually into an existing investment plan. This reduces emotional stress and limits regret if markets move unexpectedly. The chapter also cautions against pressure from others. Windfalls can attract unsolicited advice, sales pitches, and requests for financial help. The authors encourage setting boundaries and making decisions privately, based on personal goals rather than external expectations. Chapter 15 reinforces a consistent Bogleheads principle. Wealth is built through behavior, not events. A windfall is an opportunity, not a strategy. The takeaway is simple. Handled carefully, a windfall can strengthen long-term financial security. Handled emotionally, it can disappear quickly. The difference is discipline, patience, and a clear plan, not luck. Chapter 16 addresses a common and important question. Should you manage your investments yourself or hire a financial advisor? The Bogleheads begin by making one thing clear. An advisor is not automatically bad, but not every investor needs one. The real issue is understanding what kind of help you need and what you are paying for. The chapter explains that many investors are capable of managing their own finances using a simple, disciplined strategy. For these investors, paying ongoing advisory fees may not add enough value to justify the cost. Over time, even modest advisory fees can significantly reduce long-term returns through compounding. However, the authors also acknowledge that advisors can provide value in certain situations. This includes complex financial circumstances, major life transitions, tax planning needs, estate planning, or behavioral support during market stress. In these cases, advice can be more important than investment selection. A major warning in this chapter is against conflicted advisors. The Bogleheads caution investors to be extremely careful with advisors who earn commissions from selling products. These incentives can lead to recommendations that benefit the advisor more than the client. Instead, the authors strongly favor fee-only advisors who are paid directly by the client and act as fiduciaries. Fiduciaries are legally obligated to act in the client's best interests, which aligns advice with long-term outcomes rather than product sales. The chapter also emphasizes that an advisor should complement your strategy, not replace it. Even with professional help, investors must understand their own financial plan. Blindly delegating decisions without understanding increases the risk of poor outcomes and misplaced trust. Another key point is emotional discipline. Some investors benefit from having an advisor who helps them stay invested during volatile markets. If an advisor prevents panic selling or reckless behavior, the value of that guidance can outweigh the cost. The Bogleheads also suggest alternatives to full-time advisory relationships. One-time consultations, hourly planning sessions, or periodic portfolio reviews can provide guidance without long-term fee commitments. Chapter 16 reinforces a consistent theme. You are ultimately responsible for your financial future. Whether you work with an advisor or not, you must remain informed and engaged. The takeaway is practical. An advisor is a tool, not a requirement. The right advisor can add value, but the wrong one can quietly erode wealth. The key is knowing when advice helps and when simplicity does the job better. Chapter 17 focuses on a discipline that separates long-term investors from emotional ones. Monitoring your portfolio without overreacting. The Bogleheads explain that once you have a sound asset allocation and low-cost investments in place, your job is not to constantly make changes. Your job is to stay aligned with your plan. Over time, different assets grow at different rates. Stocks may outperform bonds for years, or bonds may outperform stocks during market stress. When this happens, your original asset allocation drifts. A portfolio that was once balanced can gradually become riskier or more conservative than intended, without you noticing. This is where rebalancing comes in. Rebalancing means adjusting your portfolio back to its target allocation by selling assets that have grown beyond their intended weight and buying assets that have fallen below it. This process enforces discipline and prevents risk from creeping higher during long bull markets. The chapter emphasizes that rebalancing is not market timing. It does not attempt to predict future returns. Instead, it is a rules-based process designed to control risk and maintain consistency. The Bogleheads discuss different rebalancing approaches. Some investors rebalance on a fixed schedule, such as once a year. Others rebalance when allocations drift beyond a set percentage range. The specific method matters less than having a clear rule and following it consistently. Another key idea is restraint. Tracking your progress does not mean checking your portfolio daily. Frequent monitoring increases emotional reactions and encourages unnecessary trading. The authors recommend periodic reviews, not constant observation. The chapter also warns against performance comparisons. Comparing your portfolio to others or to short-term benchmarks can undermine confidence. A well-constructed portfolio will not always outperform every index in every year. Its purpose is to meet your goals with an acceptable level of risk. Costs and taxes are also considered. Rebalancing should be done efficiently, using new contributions or tax-advantaged accounts when possible to minimize tax impact. Chapter 17 reinforces a central Bogleheads belief: investing success comes from process, not prediction. The takeaway is straightforward. Track progress to stay disciplined, not to seek excitement. Rebalance to control risk, not to chase returns. Because the real danger isn't market movement. It's drifting away from your plan without realizing it. Chapter 18 focuses on a challenge every investor faces: information overload. The Bogleheads argue that modern investors are surrounded by constant noise, financial news, market forecasts, expert opinions, breaking headlines, and social media commentary. While this information feels useful, most of it does more harm than good. The chapter defines noise as information that creates emotional reactions without improving decision-making. Daily market movements, short-term predictions, and sensational headlines rarely help investors achieve better long-term results. Instead, they increase anxiety and encourage unnecessary action. A key point in this chapter is that markets incorporate information quickly. By the time news reaches individual investors, it is already reflected in prices. Reacting to headlines often means reacting too late, buying after prices rise or selling after prices fall. The authors explain that financial media thrives on urgency. Headlines are designed to grab attention, not to support long-term planning. Predictions about interest rates, recessions, or market crashes may sound convincing, but they are rarely accurate or actionable. Another important message is that activity feels productive, but it isn't always productive. Constantly checking portfolios, reading commentary, or adjusting strategies creates the illusion of control. In reality, it increases the risk of emotional decisions and undermines discipline. The Bogleheads emphasize that successful investing requires selective ignorance. Investors must deliberately ignore most short-term information and focus only on what truly matters: asset allocation, costs, taxes, diversification, and long-term goals. The chapter also addresses the psychological cost of noise. Frequent exposure to market commentary increases stress and reduces confidence, especially during volatile periods. This makes it harder to stay invested when patience matters most. Instead of reacting to noise, the authors encourage investors to follow a written investment plan. When decisions are made in advance, markets become less distracting. The plan acts as a filter, blocking out irrelevant information. Chapter 18 reinforces a central Bogleheads principle: doing less is often the smartest move. The most successful investors are not the most informed, they are the most disciplined. The takeaway is simple: if information does not help you make better long-term decisions, it is noise. Tune it out, stay focused on your plan, and let compounding do the work, quietly, without drama. Chapter 19 addresses what the Bogleheads see as the single biggest challenge in investing: controlling your emotions. The authors argue that most investment mistakes are not caused by lack of knowledge, poor math, or bad information. They are caused by fear, greed, impatience, and overconfidence. Even a well-designed portfolio can fail if the investor cannot stay disciplined. During emotional stress, this chapter explains that markets are inherently volatile. Prices rise and fall, sometimes sharply, and often without clear reasons. These movements trigger emotional responses: excitement during bull markets and fear during downturns. Acting on these emotions is what destroys long-term results. The Bogleheads highlight loss aversion, the tendency to feel losses more intensely than gains. The psychological bias leads investors to sell during market declines to avoid further pain, even though doing so often locks in losses and prevents recovery. Another emotional trap discussed is overconfidence, when markets perform well. Investors may believe their success is due to skill rather than market conditions. This often leads to excessive risk-taking, concentration, or attempts to time the market, usually just before conditions change. The chapter reinforces the importance of having a written investment plan. A plan defines asset allocation, rebalancing rules, and long-term goals in advance. When emotions run high, the plan serves as an anchor, guiding decisions when judgment becomes clouded. The authors also emphasize long-term perspective. Short-term market declines feel dramatic, but when viewed over decades, they become normal and expected. Understanding market history helps investors anticipate volatility and reduces the shock when it occurs. Another key point is behavioral simplicity. Complex strategies require frequent decisions, which increases emotional stress. Simple portfolios reduce the number of decisions and lower the chance of emotional errors. The chapter encourages investors to focus on process, not outcomes. You cannot control markets, but you can control behavior. Success comes from consistently following a sound process through good markets and bad. Chapter 19 delivers a direct message. Investing is as much psychological as it is financial. The takeaway is clear. If you can control your emotions, you can control your investing outcomes. Markets will test your patience. Fear and greed will always be present. The investors who succeed are not those who eliminate emotion, but those who refuse to let emotion dictate their decisions. Chapter 20 focuses on one of the most serious risks investors face in retirement: outliving their money. The Bogleheads explain that retirement investing is fundamentally different from accumulation. While working, the goal is growth. In retirement, the goal shifts to sustainability, generating income while preserving capital for an uncertain lifespan. A central concept in this chapter is withdrawal strategy. Taking too much too soon can permanently damage a portfolio, especially if withdrawals occur during market downturns. This risk, known as sequence of returns risk, means that early losses combined with withdrawals can reduce a portfolio's ability to recover. The authors discuss the idea of sustainable withdrawal rates, emphasizing that there is no guaranteed formula that works in all market conditions. While rules of thumb can provide guidance, flexibility is essential. Spending plans should adapt to market performance rather than remain fixed regardless of conditions. Asset allocation continues to matter in retirement. The Bogleheads caution against becoming too conservative too quickly. While bonds provide stability, a portfolio with no growth potential may fail to keep up with inflation over a long retirement. Maintaining some exposure to stocks helps preserve purchasing power. The chapter also addresses inflation and longevity risk. Retirees may live 20, 30, or even 40 years after leaving the workforce. Over that time, inflation can significantly increase living costs. Planning must account for rising expenses, especially healthcare. Another important topic is income sources. Social Security, pensions, and portfolio withdrawals should be coordinated thoughtfully. Claiming decisions, timing, and tax implications all affect how long assets last. The Bogleheads stress the value of simplicity and discipline during retirement. Frequent strategy changes, market timing, or chasing income-producing investments can increase risk rather than reduce it. The chapter reinforces the importance of periodic review. Retirement plans should be revisited regularly to adjust spending, rebalance portfolios, and respond to changes in health, markets, or personal circumstances. Chapter 20 delivers a realistic message. Retirement success is not about maximizing income. It's about managing uncertainty. The takeaway is clear. Making your money last requires flexibility, patience, and risk awareness. In retirement, the goal is not to beat the market, it's to support your life for as long as it lasts. Chapter 21 shifts the focus from growing wealth to protecting it. The Bogleheads emphasize that insurance is not an investment. It is a risk management tool designed to prevent financial ruin from unexpected events. The core idea of this chapter is simple. You should insure against risks that are large, unpredictable, and financially devastating, not minor inconveniences you can afford to handle yourself. The authors begin by explaining the purpose of insurance. Its job is to transfer catastrophic risk away from your personal balance sheet. Events like serious illness, disability, liability lawsuits, or property loss can wipe out decades of disciplined investing if left unprotected. A major focus is health insurance. Medical costs are one of the largest and most unpredictable financial risks, especially later in life. The Bogleheads stress maintaining adequate coverage and understanding deductibles, out-of-pocket limits, and network rules. Next, the chapter covers disability insurance, which the authors argue is often more important than life insurance during working years. The risk of losing income due to illness or injury is far greater than the risk of early death. Without income protection, even a strong investment plan can collapse. Life insurance is discussed in practical terms. The Bogleheads recommend term life insurance for those who have financial dependence. Its purpose is to replace income and cover obligations, not to build wealth. They strongly caution against confusing insurance with investing, particularly with complex permanent life policies. The chapter also highlights liability insurance, including auto, homeowners, and umbrella policies. Legal liability can create losses far exceeding the value of physical assets. Adequate liability coverage is essential for protecting accumulated wealth. Another important point is avoiding overinsurance. Insuring small, manageable risks often leads to higher premiums without meaningful protection. The goal is efficiency, not maximum coverage. The Bogleheads encourage regular insurance reviews, especially after major life changes such as marriage, children, career shifts, or retirement. Chapter 21 reinforces a broader philosophy. Wealth is fragile if it is not protected. Insurance allows investors to take appropriate investment risk without fear that one event will undo everything. The takeaway is clear. You don't buy insurance hoping to use it. You buy it so that one bad event doesn't destroy a lifetime of disciplined decisions. Protection is not optional. It's part of responsible investing. Chapter 22 focuses on an often ignored part of financial planning. What happens to your assets after you're gone? The Bogleheads make it clear that estate planning is not just for the wealthy. Anyone with savings, property, or dependents needs a plan. Without one, state laws, not your intentions, will decide how your assets are distributed. The chapter begins by reframing estate planning as an extension of responsible investing. Building wealth without planning its transfer can create confusion, family conflict, unnecessary taxes, and legal delays. A clear plan protects both assets and the people you leave behind. The authors emphasize the importance of basic estate documents. These include a will, durable power of attorney, healthcare proxy, and living will. Together, these documents ensure that decisions about finances and medical care are handled according to your wishes if you become incapacitated or pass away. A key topic in this chapter is beneficiary designations, retirement accounts, insurance policies, and some investment accounts pass directly to named beneficiaries, regardless of what a will says. The Bogleheads stress that outdated or missing beneficiary designations are one of the most common estate planning mistakes. The chapter also addresses tax efficiency and wealth transfer. While not everyone faces estate taxes, poor planning can still trigger unnecessary income taxes for heirs. Thoughtful asset placement and beneficiary choices can reduce tax burdens and preserve more wealth for the next generation. Another important theme is simplicity. Complex estate structures are often unnecessary and can increase costs and confusion. The Bogleheads encourage straightforward solutions, unless circumstances clearly require more advanced planning. The authors also discuss the emotional side of estate planning. Clear instructions reduce stress for loved ones during an already difficult time. Estate planning is presented not as a financial exercise, but as an active consideration and responsibility. Regular review is emphasized. Life events such as marriage, divorce, children, or changes in assets should trigger updates to estate plans. An outdated plan can be almost as harmful as having no plan at all. Chapter 22 reinforces a core message. Estate planning is not about death, it's about clarity. The takeaway is simple. If you care about the people who matter to you, make decisions now, not later. Passing on wealth thoughtfully ensures that your financial discipline continues to serve its purpose. even after you're gone. Chapter 23 serves as the conclusion of the Bogleheads Guide to Investing, and its purpose is not to introduce new strategies, but to reinforce confidence. The Bogleheads close the book with a clear statement. Successful investing is not reserved for experts, professionals, or market insiders. Ordinary investors can succeed by following a simple, disciplined, and consistent approach. The chapter revisits the core philosophy of the book. You don't need to predict markets. You don't need to beat other investors. You don't need complex products or constant activity. What you need is a sound plan built on diversification, low costs, tax efficiency, and long-term commitment. A key theme here is personal responsibility. The authors emphasize that no advisor, fund manager, or system will care more about your money than you do. Taking ownership of your financial decisions is empowering, not intimidating. Understanding your strategy gives you confidence during market volatility. The chapter also acknowledges that staying the course is not always easy. There will be market crashes, economic uncertainty, and emotional pressure to act. The Bogleheads normalize this discomfort and remind readers that volatility is not a failure of the system, it is the price of long-term returns. Another important message is patience. Investing rewards those who remain invested over long periods, even when results feel slow or boring. The authors emphasize that boredom is often a sign that a strategy is working. Excitement usually comes from speculation, not discipline. The chapter reinforces the importance of process over outcome. Some years will be good, others disappointing. Success is not measured by short-term performance, but by adherence to a sound plan over decades. The Bogleheads also stress that investing should support life, not consume it. A well-designed strategy frees mental energy, reduces stress, and allows investors to focus on what matters beyond money. Chapter 23 ends on a confident, practical note. You don't need permission to invest wisely. You don't need constant reassurance. You already have the tools. The takeaway is simple and direct. You can do this. With discipline, simplicity, and patience, long-term investing is not complicated. It's achievable. The Bogleheads Guide to Investing delivers a message that feels almost uncomfortable in a world obsessed with fast money and bold predictions. You don't need complexity to succeed. You need discipline. Across 23 chapters, the book systematically removes the myths that surround investing. It shows that long-term success is not built on stock picking, market timing, or chasing the next big trend. It is built on behavior, structure, and patience. The Bogleheads begin by reframing investing as a lifestyle decision before markets even matter. Your spending habits, savings rate, and debt choices determine whether investing can work at all. You cannot out-invest poor financial behavior. From there, the book emphasizes starting early and investing regularly, allowing compounding to do the heavy lifting. Time in the market matters far more than timing the market. A major portion of the book is dedicated to understanding what you own. Stocks, bonds, funds, and investment products are explained clearly, with a strong warning against complexity and opaque products. If you don't understand how an investment works, you don't own it, it owns you. The core engine of the Bogleheads strategy is simple: broad diversification, low costs, thoughtful asset allocation, tax efficiency, long-term discipline. The book repeatedly reinforces that costs and taxes compound negatively, just like returns compound positively. Controlling what you can control gives you a structural advantage over most investors. Behavior is a central theme. The authors show how performance chasing, market timing, emotional reactions, and media noise destroy returns. The biggest risk to your portfolio is not the market, it's how you respond to it. Later chapters shift toward real-life applications, college planning, managing windfalls, working with advisors, rebalancing, retirement withdrawals, insurance, and estate planning. The message stays consistent. Investing should support your life, not dominate it. The final chapters emphasize confidence. Ordinary investors don't need permission from Wall Street. With a simple plan and the discipline to stay the course, long-term investing becomes achievable, repeatable, and surprisingly calm. The ultimate lesson of the book is this: you win by doing fewer things, but doing them consistently, for a very long time. If this summary helped clarify how long-term investing actually works, not the hype, not the headlines, then you're already ahead of most investors. Like this video if you believe simplicity beats speculation. Subscribe to the channel for more clear, no-nonsense breakdowns of the world's best investing books. Comment below what's the hardest part of investing for you: staying patient, ignoring noise, or controlling emotions. And remember, you don't need to beat the market. You just need to stay in the game long enough for it to work. See you in the next video.